I'm Simon Brown, founder of Just One Lap, FinWeek columnist and presenter on Business Day TV. I've been trading derivatives since 1995, primarily focusing on indices and currencies. I trade my own mechanical trend-based systems. I use a lazy system, momentum, 721, engulfing candles and gap closes. What is a CFD? A contract for difference, or CFD, is a financial instrument. It allows you to pay a deposit to place a trade instead of paying the full value of the trade and acquiring the shares outright. The deposit is determined by the provider and is a percentage of the full value of the shares that you want exposure to. The full value of the shares is called your exposure and the deposit is called your margin. We have a video explaining how margins work. Your CFD provider takes your margin and places a trade in the market for the full value of the shares you wanted if they are available for the price you want. For example, if you buy 25,000 Rand worth of shares, this is your exposure, but you'd only pay, say, 3,500 Rand margin. The CFD provider then holds the shares while you hold a contract to profit from the share price movement. If the price of the shares you bought goes up, you make a profit on the full value of the shares, even though you just paid a margin. This process is called gearing. Keep an eye out for our video on gearing and margin. CFDs can be used to trade ordinary shares, indices, commodities, or currencies. If you expect the price to go up, you take out a contract that will profit from the upwards movement. If the price moves higher, the profit earned from selling at the higher price comes to you. This is referred to as going long. In another video in this series, we explain what it means to go long or short. For example, if the shares you bought goes up 10%, you make 2,500 on your exposure of 25,000, while only having put down a margin of 3,500. This is a 70% profit on your margin of 3,500. If you expect the share price will go up, but it goes down instead, you will have to pay the difference in price movement to your CFD provider. Again, this amount applies to your exposure, not your margin. For example, if the share lost 5%, you would lose 1,250 Rand on your exposure of 25,000. You owe this money to your CFD provider and it will be taken from your cash account. If the exposure dropped by 20% in value, you would have to pay 5,000 Rand. This is more than your margin. You can lose more than you start with. You can also make a profit on a fall in the share price. This is called going short. CFDs allow you to make money from price movements, but it's important to remember you don't own the shares. You own a contract for the difference in the price from when you entered the position to when you exited. This means you don't have the same voting rights as people who hold the shares outright and has implications for dividend payments. If you hold a long position in a company that issues dividends, the dividends will be paid to you in cash. If, however, you've shorted a company that pays a dividend, the cash dividend amount will be deducted from the cash in your CFD account. We explain CFDs and dividends in another video. Remember that CFDs are a leveraged product and can result in losses that exceed your deposits. Trading CFDs may not be suitable for everyone, so please ensure that you fully understand the risks involved. CFDs are great, transparent products for traders looking to profit from short-term market movements. To learn more about CFD trading, go to ig.com/seminars to register for one of IG's free events.